Hey guys, I'm John Fryer. Welcome to Fryer Funds, welcome to my kitchen, and welcome to the Fryer Feast series. In this series, we took $15,000, we're investing it into individual companies, with all investment decisions made over the weekend to be executed on Monday. This is for people who work 9 to 5, who don't have time to trade during the week or make decisions during the week, so we focus on the weekend execution and go from there. Now, I want to point out, this is not financial advice, this is not legal advice, consult your own advisors, and make your own decisions. But with that said, let's dive in, see what happened this week, and where we're going from here.
Alright guys, so we have a lot to talk about this week, but let's start with the S&P 500 reaching its all-time high on Friday. It actually hit it on Wednesday as well, but then beat that on Friday and closed out for the weekend at its all-time high. It was up for 0.5% this week, which is awesome. The Fryer Feast, meanwhile, this week wasn't our greatest. We're down $10 on the top line technically, so we're flat because it's too small of a percentage. So we're basically flat while the S&P went up this week. And also big news, awesomeness for Apple. Apple hit $2 trillion. They're the first U.S. company to do so. Yeah, that's kind of an interesting landmark. I actually remember when they hit $1 trillion. It was just 2 years ago. And I thought at that point, wow, I don't know if Apple can get much bigger than this. I expected a little bit, but I did not expect $2 trillion in just 2 years. I didn't expect them to double. So, yeah, congrats to Apple for being the first U.S. company to hit $2 trillion. And they might be the first company to hit $3 trillion, unless Tesla wants to come up and just hit $3 trillion because everyone likes the stock, not because the company's that great. I mean, Tesla's good, but I mean, it's no Apple. Anyway, so cool. So let's talk about this. The S&P 500 being at the all-time high, and why is that with everything going on? And it's because of how it works. So the S&P 500 is the 500 largest companies by market cap in the U.S. that are also good companies. There's more than just the market cap for the S&P 500. But it's the 500 largest companies by market cap with some other things that they need to have in place to qualify. So they evaluate all the companies every quarter, and the companies that shrink, that aren't doing good, are removed from the S&P 500, and then they're replaced with companies that are now bigger and doing better. And so, for example, earlier this year, Macy's, which is a big department store, not doing well. They haven't been for years. They've kind of been going down. So they were finally removed from the S&P 500 in, I believe it was March, actually, just after the pandemic started. And then the next quarter, now there was a split of another company, and so Macy's was removed and not necessarily directly replaced. And there was some other movements. But anyway, so Macy's was removed and has done poorly. Meanwhile, Domino's in June was added to the S&P 500, and it's gone up a lot this year. Macy's is down 61% since its high in February. Domino's is up 41% since February. So yeah, companies do move in and out in the S&P 500, although for most quarters it's like 1 or 2 companies. It's not generally very many, which we'll get into a little more here in a little bit. So that's part of the reason why the S&P 500 is at a record high, is because these big companies are doing well, they're getting bigger, the S&P is growing. It's also market cap weighted. So the bigger companies in the S&P 500, the top companies, as they get bigger, the S&P 500 grows. Even if those smaller companies are getting smaller, they don't have as much weight because they don't have as much market cap. So, for example, what I'm talking about here, back in April, these 5 companies, the top 5, Apple, Microsoft, Amazon, Google, and Facebook, the 5 of them combined for about 15% of the S&P 500. Now, since April, all 5 of these companies have grown. We already talked about Apple hitting $2 trillion, Amazon's grown like crazy, Microsoft's done really well, Facebook's done really well, Google's the only kind of laggard, but even they've done pretty well. But of these 5, Google's behind right now. Anyway, so because these companies have grown and a lot of the other companies in the S&P 500 have shrunk, these guys now account for 23% of the S&P 500. And as a matter of fact, 15 companies, these 5 and 10 others, account for 33% of the S&P 500 now. So if the other 485 companies went down by 1% in one day, and these 15 companies went up just 2%, then overall the S&P 500 would be flat because it's market cap weighted. Now there's some other factors in there based on floating shares, and there's caps and stuff, but we're nowhere near the caps, and those other things aren't. I'm simplifying it here a little bit, but this is the majority, in that because the bigger companies are getting bigger and the smaller companies are what's getting smaller, that's why the market's at the all-time high. If it was the other way around, and these big companies were shrinking and the smaller companies were growing, the smaller companies would have to grow at a faster pace than the bigger companies shrinking for the S&P 500 to be going up. So we'll talk about that here a little bit. So September is, or next month, the committee, the S&P 500 committee, or the S&P committee, because they go over all the indexes here, meet in September to I can't think of the word. So they redo the S&P 500, what's included and what's removed. So this might be one of the biggest changes to the S&P 500 in a long time, because there are 60 companies in the S&P 500 that technically currently don't qualify based on their market cap. So over 10% of the S&P 500 don't qualify for the S&P 500 anymore based on their market cap. There's a limit of $8.2 billion in market cap, and there are 60 companies that don't have that big of a market cap anymore. Also, in the S&P mid-cap 600, which is similar to the S&P 500 but for slightly smaller companies, and 600 instead of 500 of them, there are 40 of those companies technically do qualify for the S&P 500, and there are other companies like Tesla that didn't qualify for either until now, because you have to be profitable for at least a year before you can be considered for these. At least I know that for sure for the S&P 500. I think that's true for the mid-cap, but they're not in the mid-cap either, so I'm assuming so, and that's probably why. So 10% of the S&P 500 could swap out. I don't actually think that many will swap, because the committee isn't like, it's not a hard set computerized rule, right? At their discretion, they can kind of change what goes in and out, and that market cap changes. That 8.2 billion might go down. So not necessarily, but it's possible that 50 companies could swap in or out. 10%, right? That's a lot. I don't actually think it'll be that many. It'll probably, if I had to guess, it might be 10, 15, but who knows? Most quarters, it's like 1 or 2. So this could be the biggest change to the S&P 500 we've seen in a long time. And there's more considerations than market cap, right? So profitability, which we already talked about a little bit, what sector they're in, right? They try to balance it. There's 11 main sectors, and they don't put equal weight across all the sectors, but they try to diversify in them, and I don't know all the rules. There's a lot of documentation if you want to go read it. But most quarters are 1 or 2 companies, and I'm expecting a lot of companies to swap out. Probably not the 650 or 60, but if so, that's 10% of the S&P that swaps out. Now, that doesn't mean the S&P value changes overnight based on what they move in and out, because it tracks the performance of the companies in there, not the total market cap of what's in there. So overnight, it doesn't just change. It just starts following different companies and their performance. So when this happens, mega cap tech stocks won't have as large of an impact. It won't be 23% anymore. Sure, we'll change that. The top 15 companies won't be 33%, and these 5 won't be 23% anymore. It'll still be high, but it won't be as high. So that'll be kind of good, I believe, unless they're growing bigger still, which is possible, like Apple's still growing. If they keep growing, they won't have as big of an impact. Same with if they start to shrink. So, but how could this cause an inverse of the market to the economy? And this is what I want to talk about or point out. So if the economy starts to recover, we could see the market drop, the market being the S&P 500. Alternatively, it could be the inverse, in that if the economy starts to shrink, the market could actually go up even higher, or economy shrink, or the pandemic basically causes more issues. So let's talk about how this could happen. So first, for the S&P 500, future stock performance is not considered for what they include. They also don't technically consider past performance, although to get the market cap to be in the S&P 500, the stock has to be going up to increase the market cap. So it's not technically considered, but is sort of considered, unless you had a stock that stayed flat or came down a little, but the company all of a sudden became profitable, like say Tesla. Say Tesla qualified in everything but profitability and hadn't been going up like it has been, but was just flat from here. So it technically could have not came up and ended up being included. But anyway, I digress. So companies that are growing right now that could get included in the S&P 500 that aren't there may not perform well next quarter or next going forward, say for the year or whatever, as the rotation out of those stocks happens and that rotation goes into the recovering stocks. So depending on what moves around, and I'll get into an example of what I mean. Depending on what moves around in the S&P over this in the next month, will kind of determine what it will do going forward with the pandemic. It won't have the same fluctuations or the same trajectory as it has thus far. So it's possible, if next month things swap out, that as the economy recovers, the S&P 500, all those big companies, and now big companies, will start to sell off, their market cap will shrink, causing the S&P 500 to shrink, while the companies that have been suffering start to grow and go up. I mean, they'll go up and the economy will go up, but the S&P 500 might go down. So it's kind of hard to put into words unless we talk about an example, which I have here in a second. So say the pandemic starts to weigh heavily on the economy again. We have another wave. But all the companies in the S&P 500 are now these companies that have grown because of the pandemic. They'll continue to grow if the pandemic comes back. So the pandemic comes back, economy starts to suffer more, the S&P 500 might actually increase and continue to go higher. So let's just talk about an example here because it's the easiest way to explain it. So right now, the S&P 500 does not include Zoom, ZM. Next month, they might put it in. It technically qualifies as far as I know right now. Norwegian Cruise Line, NCLH, is currently in the S&P 500, but doesn't technically qualify based on market cap. So it could get removed from the S&P 500. So let's say this happens. Now if this happens, and then a vaccine is found in October, or November, or obviously eventually a vaccine will be there, but so a vaccine is done. That's why I wrote done here. The vaccine is done, Zoom could start selling off, and because it's in the S&P 500, that'll cause the S&P 500 to go down. Yes, there are 499 other companies, so this is just one example, but let's say 10% of the S&P 500 swaps out like I was talking about earlier, and you take all these suffering companies like the Norwegian Cruise Line out, and you put in companies like Zoom that are succeeding right now, but then the vaccine is done, Zoom goes down, causing the S&P 500 to go down. Alternatively, this move happens, Zoom's in the S&P 500, then the pandemic comes back and we have a huge big wave of it, Zoom starts to go up, the S&P 500 starts to go up. So pandemic is back, Zoom grows, S&P 500 grows. Pandemic goes away, Zoom shrinks, S&P 500 shrinks. So the S&P 500 could be an inverse of what's going to happen with the pandemic and the economy going forward, depending on what gets moved in and out. So even though we're at an all-time high now, and we could keep going higher over the next month because the big companies are going to continue to get bigger in theory, when a vaccine is found, by the time that happens and the real rotation starts, as cruise lines come back online, which I believe Norwegian and themselves is starting October 1st or 31st, which will be after the new S&P 500, we could see the S&P 500 do the inverse of what the pandemic does. So think about that. The pandemic is getting worse and the market goes up, or the pandemic is getting better and the market goes down. It's a possibility. Now, granted, it's not going to be a huge, huge move. 10% of the S&P 500 swapping in and out is a big deal, but it's the 10% of the smallest companies that have the smallest amount of impact. But a lot of the big companies now, right, those 15 companies that are now 33% of the S&P 500, those 15 companies have been doing really well because of the pandemic to an extent. So they will start to shrink, causing the S&P 500 to shrink as well. So we could see the S&P 500 go down when the economy starts to come back up, as a rotation happens, as the bigger companies shrink and the smaller companies get big again. So Norwegian will grow, Macy's will grow, as we talked about, and other companies that have really suffered. Airlines, obviously. So, I think that's a really interesting concept. Next month, we'll definitely want to see what happens to the S&P 500, see what gets included. But this is why I prefer individual stock picking over actually the index for a good portion. I don't get me wrong, I do actually have a lot of money in the S&P 500 in other accounts, but I don't count on that to make the majority of my growth. It's the stock picks that make the growth, because you can tell what's going on, and as the big companies get smaller, you don't have to invest in them as your stock picks. Not that we haven't invested in them. Anyway, so I think this is really interesting. The S&P 500 all-time high because the big companies keep getting bigger, and then when the swap happens next month, I think it's like the third Friday in September, so we're still a full month away from this. But it'll be interesting to see kind of what happens, and if a lot of companies do get moved into the S&P 500 that are pandemic benefiting. I hate to say that, but companies like Zoom get in the S&P 500. We could see the S&P 500 do the inverse of what happens with the pandemic. So we could have a major sell-off, which will give us opportunity to buy at least the index, if not the big companies later. But so that's all I want to talk about on that. So let's talk about the Friar Feast and what we're kind of doing, or what's happening this weekend. Apple and Tesla are splitting their stocks. So each share price will be down starting, I think, Tuesday morning. So not for this weekend. Tesla might have been this weekend. But anyway, so this doesn't technically add value, although both stocks have skyrocketed since announcing this. Because you take a $20 stock, a $20 bill, and now you just have 4 $5 bills or $5 stocks. Obviously, in this case, Apple's a $500 stock getting cut down to $125. Tesla's a $2,000 stock getting cut down to... what, 500? Oh, is their stock split 4 or 5? If it's 5, it's a 400. Anyway, so so we'll see what they do. It might give us a chance to. We already own Apple, so we may sell out some just to take some profit, and we don't own Tesla because it's been way too expensive. So if it drops after the split, we might buy into it. So we'll see what happens there. Otherwise, so I talked about when we wanted to simplify this portfolio and start taking profits when things spike up. After we swapped out the grill and reworked it, sure enough, we timed it just right in terms of getting into the right companies, and they all started to go up that week, but then they sold back off a little bit and sold off a little bit more, and we couldn't really take profits because it wasn't worth it over the weekend, but midweek there were profits. So what we're going to do, because these are more short-term trades and recovery rotation trades at this point to an extent, we're going to take advantage of these midweek rotations by automation. And what we're going to do is we're going to set a limit order that's good till canceled, extended hours included, because we like those. That's when a lot of the movement happens, on all the stocks in the recovery or on the grill. So let me show you what I'm talking about. I'll give an example. So American Airlines, right here. Okay. Actually, we're going to go over. So this is the spreadsheet I have. I don't know if you can see this. Let me zoom in a little bit. This is the spreadsheet I have, which is down in the description if you want to see all the stats and stuff. Down there, I'm going to move this over. So if you want access to the spreadsheet, down in the description, there's a link to that along with the notes. And then, of course, if you want to join Webull, get 2 free stocks, or Robinhood, get a free stock, join M1 Finance and get $10. And I think I have an Acorns link down there as well. You can get $5. Down in the description, bunch of links, check them out. And if you haven't started investing or want a new broker or want to put money in separating brokers, use the links down below, get your free stocks or your free money. But I digress. So let's talk about this. So what I've done in this spreadsheet here is a limit set and the quantity set. So AAL, which we currently own, our average cost basis was $10.87. Well, I want to sell some of that when it gets up to almost $15, just under $15. I don't want to hit exactly. Some of them will hit exact. So I'll sell at $15, I'll sell 3 shares, which we currently own 13 shares. So we're not completely selling out of this position. Just 3 shares of it at $15. So what we'll do is we do a close order on Webull, sell, limit, I only want to sell 3. We're setting the price to $14.95. Time force is GTC or good till canceled, depending on if you're using Webull like here, or if you're using Robinhood, or if you're on Fidelity or another brokerage. It may be a little bit different, but it'll be good till canceled or GTC, and you want to turn extended hours on. At least that's what I'm doing. Okay, and then place order. Now in this case, I actually can't. Yes, there's a large gap. Of course there is, because this is a long time just waiting for it to spike up, which could happen on Tuesday. Who knows? Hey, continue. I can't place orders on Webull over the weekend. It's ridiculous. This is one reason I don't like Webull and wished I had used a different platform for this portfolio, because I could use this for my midweek trades otherwise. And yeah, if we reset the Friar Feast, I'll probably be using a different brokerage just for that one reason. Otherwise, I mean, there's a lot of good info. I actually like Webull for a lot of things, but not being able to place in extended trades over the weekend just really bites. So I'll have to do all these on Monday morning. So I'll go through all of these. Most of them is just a part of the position. Some of them are complete sellout. So one is oil, and actually I talk about this here. Whoa, that's that really zoomed in. Let's zoom out a little bit. So we're looking to get out of oil stocks, or at least I am, because oil's been a short-term play. It hasn't bounced up as much as I would have liked. We have the election coming up, and if Biden wins, oil's really going to possibly take a hit. Even if Trump wins, I don't see oil really recovering. The previous levels of demand are never to come back, even as cruise lines come back. Airlines were a long ways away from them eating up as much fuel or demanding as much fuel. And even when passenger demand is the same as it was in 2019 in a few years, by then, in theory, they'll have better engines, they'll have better parts, so they won't be using as much fuel. So I don't think oil is ever really going back to where it was. And with the election coming, there's just too much risk here with oil, and I don't want to play it anymore, and it hasn't moved like I was hoping it would. So we're actually, on the next good bounce of oil, we're going to go ahead and pull out. So on oil down here, oh, that's fine. Now I see. On oil, I've got a complete sellout on those when they bounce up a little bit from where they're at. And unfortunately, we have lost some money on these. We took profits on oil previously. I don't have that in the spreadsheet anymore, but I know we sold out some other oil stocks and even on these. And actually, no, we never did take profits on these, I don't think. I'll have to double check that. Maybe we did and I just didn't write it down. So I will double check that. But yeah, so we're going to pull out of oil when the stock bounces back up. It'll still give us a little bit of profit from where we're at. WTI is the only one that will be a decent amount, but I think WTI could, just because of the OPEC meeting, they're not drilling too much oil. That one's the only one I don't necessarily want to pull out right away, so I'm setting a higher limit at $3. So yeah, we're pulling out of oil for sure. These casinos, we'll pull out of them when they get to these levels. We're already selling. I haven't gotten into that yet. There's a couple moves I'm going to do tomorrow, assuming they don't gap. But yeah, most of these are just partial positions. Again, if you want to look at this, take a deeper dive look. The link is down in the description. And yeah, you can look at the grill. We have the frying pan here in terms of all the companies that should do well with the pandemic to an extent. Obviously, not all of them have. I wanted to buy Z last week, but unfortunately on Monday I didn't get up early enough, so I didn't do it in the morning. By that afternoon, it had gone up above our cost basis and actually climbed all week, so I should have bought anyway, but that's okay. So yeah, we only have one share of that still. I'd still like to grab another share of Chegg one of these weekends, but it's not down enough. I think there's still more dropping to come to that. But otherwise, I'm keeping everything the same. One I am looking forward to this week is HPQ. They report earnings on Tuesday or Wednesday. and I'm expecting a good number from them. I kind of want to buy more, but I've already hit my technical limit for the portfolio, so I'm not going to. I will say that in my other portfolios, I bought a few more shares of HPQ just under $18. It's down to $18.23. I also bought a call option at $20 and $22. So I'm really expecting HPQ to blow it out, and because no one's paying attention to the stock and it's just kind of been flat in a small little range between 17 and 18, I did get almost up to almost 19 last week, but it came back down. So this little range kind of been a silent stock. I think when they report and they are selling a lot of laptops, and I expect a lot of printers to be sold, which no one's talking about because everyone's working from home. So I like HPQ here. I want to buy more, but I technically count in this portfolio, so I'm not going to, but I do like HPQ. But yeah, anyway, so the rest of these, and then of course our crockpot, which we've made a decent amount, 37%, check that out. We sold out of quite a few on here. But yeah, so if you want to check out the spreadsheet, link down in the description, and with that. So yeah, looking at the oil. But here's the moves I'm doing tomorrow, assuming no gaps. And even so, most of these, we still, even if it gaps, I may still end up doing it just because of where they're at. So buying 3 more shares of Sabre to lower our cost basis. They just announced some loans that investors, I guess, didn't like. It knocked the share price down. I still think this is a long, good travel recovery software investment. So I want to lower our cost basis. It could go down more, down to $6. It's currently at $6.79. As a matter of fact, let's take a look at it here just to show you what I'm talking about here. So Sabre here, we've lost 30% on it because we bought it actually kind of at the wrong time. It dropped just after we bought, and then has continued to kind of stay flat, go down a little, and then it just gapped down again after the loans that they announced. So we're going to lower our cost basis by 3 more shares. If it jumps up to $10 again, just above our current cost basis, we'll sell 7 shares at that point because we'll own 22, get down to 15. But if it drops down to $6, because it's currently sitting at $6.76, if it drops down to $6, we'll buy 3 more shares at that point, we'll own 25. So I still think this is a good one that as things recover, the airlines and the travel agencies, they will all use Sabre software, and their subscription and profit, everything's going to go up. So Sabre's a good long-term recovery play, and as it goes down, it'll give us a chance to lower our cost basis because it is kind of high right now compared to where the stock's at, because we're down 30%. Bad timing, but that's okay. That's okay. Long term, it's going to be much higher. It's going to go up to, I don't remember what the actual number is, but I think it was up to a $40 stock. So this has got a 4x return in the next year or two. So I'm looking forward to that. So we're going to buy Sabre. RCL, the cruise line, has kind of hit its peak, give or take, since the pandemic started, after the sell-off at least, since March. And so we're going to go ahead and take some profits there. MGM, kind of the same thing. Same with GDEN, Seas, Eventbrite, Groupon. And let me show you what I'm talking about on these. So RCL, let's take a look at RCL stock. Oh, it's not going to let me open it from here. Fine. I'll do it from here. RCL. There you are. Okay, so if we look at this year to date. So before the sell-off, it was sitting up here 135, kind of came down to the 115, 120 area, right? Then the sell-off happened, starting here on the 20th. That 19th was the peak of the market. Sell-off happened, got down to 22. Then came up in the beginning of June with that huge spike that we've seen with everything, and got up here to about 76 and bounced back up to about 63. Well, it's currently sitting at 61, so almost at 63. If we see a sell-off, it could drop back down easily to 50, maybe even 45. Our current position is basically where it could sell off to. So there's not a lot of downside, but I do want to take a little bit of the profit, lower our exposure here, because if there is a sell-off, I think of the cruise lines, this one will sell off most. And if you look at another cruise line, let's take a look at whichever one pops up first here, CCL, there we go. CCL, same kind of thing, but it's actually currently sitting about our cost basis, right? Our cost basis is $14.64, it's at $14.65. So it's right there. So if there's a sell-off, yeah, it could go down, but that'll just give us a chance to lower our cost basis. But really, it's kind of just sitting at the bottom. CCL hasn't reported earnings yet, and that's why, whereas NCLH and RCL have, and both of them have gone up. CCL took advantage of that too. Oh, hey, there we go. NCLH, here we go, perfect. So we're a little bit below. It went up as well, but not as high. So anyway, we're taking off RCL. Take a look at MGM. Here was our peak back in June at 23. We're currently sitting at 21. So there's a little bit more upside, but I want to go ahead and take some profits here. So if it does sell off, we can buy back in if we need to. And if not, if it keeps going up, then cool. We'll just keep taking profits until we get to our previous pre-pandemic levels. But yeah, so that's what I'm talking about on these, in that we're going to take profit, but we're not taking the position off. We're just taking profits. So RCL, MGM, GDEN, SeaWorld, Eventbrite, and Groupon. So we're going to take profits on these, buy a few shares of Sabre. It's going to increase our cash position, give us a few $100s more. I don't have anything else besides HPQ that I'm really excited about at these levels here. And I'm expecting a rotation and opportunity to come here the next little while, especially with the market hitting all-time highs. Investors are starting to get a little worried about the overvaluation of like Apple and Facebook and those. So I think there will be opportunity to put our cash to work soon, and I want to hold on to it for right now. So we're gonna have a little bit bigger cash position than we've had in a little while, but that's okay. We'll take advantage of that as things rotate and sell and move off. But yeah, so we'll see kind of how things go. I'm really expecting HPQ to blow it out of the water, so I'll report on that next weekend. Whatever happens, I'll be like, oh, I was way wrong. HPQ actually didn't do very well, or yeah, I was right and I should have bought more. But anyway, I digress. I think that's everything. We're already over a half hour, so links down in the description to the spreadsheet, to the notes. Get your 2 free stocks with Webull, $10 with M1 Finance. Hit like, subscribe, share, all that fun stuff that I always forget to mention in my videos. And yeah, we'll see you guys next weekend.